Market sense. Non-Asian markets fell this morning after 2 days of healthy gains. Hong Kong, the worst performer, as huge anti-government protests paralyzed key roads in the city, and that's before then turning violent. Profit takers moved into the market while investors keep a nervous eye on developments in that China-US trade saga and an expected meeting between Donald Trump and Xi Jinping expected for later this month at the G20 summit in Japan. Tokyo's Nikkei dipped 0.4% there, trading at 21,129 points, while the Hang Seng in Hong Kong lost a massive 1.7% there, still firmly above that 27,000 point mark, with the Shanghai Composite also losing around 0.6%, sitting just below that 3,000 point mark. Well, U.S. stocks ended near flat last night as investors paused following a run of gains and as fresh worries emerged over the United States' trade war with China. All three major indices on Wall Street were marginally weaker, with the Dow Jones now snapping a 6-day uptick. That's after falling in May. U.S. stocks have been on a tear through the first part of June, following dovish commentary from Federal Reserve officials that has offset unease over trade. Now, President Donald Trump's decision over the weekend to call off tariffs on Mexico has also boosted sentiment, although the ongoing trade war with Beijing and Washington remains a concern for most investors. Now, let's continue our market outlook and head on over to the likes of Europe and locally as well. Then, if we head on to this board, of course, the markets have certainly been faltering ever so slightly, and the market conditions themselves have clearly been interesting to look at from an international point of view. Very quickly as well, then, just touching on how things have been on the international market locally, not doing so well. So let's unpack all of that now with Viv Govender from Rand Swiss, who joins us live from the Johannesburg Stock Exchange. Viv, thank you so much for the time. Just down a touch for today, and I guess some profit taking perhaps formulating in the market. Is that the sentiment you're getting after around 2 days of gains?
Yes, and we've had some really big moves. For instance, companies like Naspers, for instance, have moved up quite strongly the last few days. Data, but today again, have the China news around that as well. And also I think the currency strengthening does hurt some of our, currency hedge stocks here. So we saw at some points in time overnight it was below 1470. It's weak a little bit since then, but compare that to the 15 some change we saw a few days ago. That's obviously a huge differential. So it does also weaken the market slightly.
Yeah. Okay. Well, if we shift in attention, a lot of this may have coming through from Asia, right? And that was quite negative earlier today. The likes of Hong Kong suffering, of course, with those anti-government protests on that bill that is set to come into place there. But overall, that Chinese market has perhaps suffered quite a bit. They've put in some measures to try and boost the Chinese economy. And now we're seeing that inflation number come in at 2.7%, better than expected. Is that beginning some sort of good news for the Asian economy?
Yeah, the Chinese inflation number was, I think, distorted to a certain extent by apparently high pork prices. Pork is a huge meat in China because they consume well more than their percentage of global GDP or even global population in terms of the percentage of pork they consume. And so this has a huge effect. If you take out that pork impact and some other food aspects, you'll find that the actual inflation number was below 2%. And that actually means that the Chinese economy probably has a bit more room for stimulus, which is positive considering some of the weakening signs we've seen because of the Trump trade war and other issues around the Chinese economy. So if there is some room for expansion, some stimulus, we could see the government stepping in just because they're fearing that the Trump trade war and other, like I said, issues could be putting their growth rate too low for the year.
Yeah. Well, okay. So if we shift attention then from that scenario, particularly the spat in the inflation number, the trade war still makes a lot of headlines. And of course, having seen Mexico and the US perhaps clear up their tensions, how do we then view the trade tension between the US and China? Are we viewing it with hope that a similar sort of sentiment can then be brought forward? Or are we still saying, well, it does seem that these two are at loggerheads and too hard-headed to find a solution?
Look, the issue with, I think, the Chinese have is that they're the big fish for Donald Trump. They're the thing he can use to beat or basically to show to his supporters that he's being tough on trade. He's basically being the strong man out there that they want to see in the world economy. But however, by looking at some of the stuff he's done in the past, for instance, NAFTA, as well as this Mexican deal with regards to migrants, The one thing that's positive about Donald Trump is that he can change on a dime. So the example I would use would be, look what he did with North Korea. Went from rocket man to basically love letters in the period of a few weeks. And it's quite possible if the deal was made with China and he saw it as being politically positive for himself, we could see a very, very quick and very strong ramp down of the Chinese trade tensions. But my fear is that going into 2020, when we have the US presidential elections, he's probably more positive about having a trade war with China to show his supporters that he's being tough, as opposed to trying to do what's right for the US economy by tamping down on tensions.
Would you look at that, Viv? Finally, some good news for the local market. 2.4% with regards to retail sales going up in April year on year. The likes of textiles, clothing, footwear, leather goods, those were the ones that recorded the largest annual growth rate. That's bound to be of good news, but it's still a retail segment in quite a bit of crisis there.
Yeah, look, this is a recovery from the 0.2 we saw last month and the 1.4s we are seeing for the start of the year. So the recovery is nice, over 2%. The upper end of the estimates I saw were 2%. So it was between 0.4 and 2%. The average anticipated number was around about 1.2, 1.3%. So this is a very strong number coming through. But remember, we did have a weaker number last period for 0.2. So that was quite a surprise, you know what I mean? And if you look at the average for the last 4 months, basically, we're looking at something around about 1.4, 1.5% as being the average number we are seeing over the last few months here. So it's not great, for year-on-year numbers. The South African consumer is under a huge amount of pressure. The slowing economy, of course, is one, but also things like, rising petrol prices. We have, of course, not just the oil price, the rand to worry about, but also the new taxes government has put in play. We also have issues around, in terms of South Africa at the moment, the electricity prices, the ramping up on that. There's less and less disposable income for the consumer to basically spend at the retails or the shops.
Yeah. All right. Well, it becomes a little more difficult, and I suppose the likes of ShopRite, Mr. Price, Woolworths have all shown how difficult the scenario is, of course, because even the economic situation in South Africa. Very quickly, also want to touch on that oil story there. That price now sitting just above that $60 a barrel mark and perhaps stabilizing somewhat. OPEC saying that they will withhold some of that supply, but the shale production out in the United States just goes on, right? So where exactly do we sit with that oil price? Is it just going to hover around that early $60 a barrel mark?
I don't think so. I think there's a couple of factors to worry about. Firstly, I do think that we are getting close to where the break-even point for shale is. So we're probably not that far away from it. With $5-10 a bit lower than here. I don't think shale production is profitable anymore. And at that point in time, we do see, the way the shale oil wells work is that they are very, very front-loaded. You do an oil well today, it's for this year it's very strong, next year it becomes very weak. So if it becomes below break-even, you'll find production of new wells declining quite significantly. And I still am very fearful about what's going to happen in the Middle East. I do think that there's still tensions around Iran. If we do have a ramp-up in tensions there and we do have some kind of flare-up, sometimes it's not even designed. You want to get to the edge and sometimes you fall over the edge when it comes to this kind of brinkmanship. We could see oil prices rally up very strongly from here, in excess of $80 a barrel, and some people say $100 if there is a full-on, conflict with Iran. So where we are right now does seem to be stable. I think there is support very, very close to this level for the oil price, and there is a danger that if things go badly, we could see oil prices basically rally quite strongly from here. Like I said, in the case of a conflict in the Middle East.
Yeah. Viv, appreciate your time. Really great chatting to you, but appreciate it there. Viv Govender from Rand Swiss joining us there live from the Johannesburg Stock